Bitcoin and Ethereum are arguably the two most popular cryptocurrencies out there and have greatly contributed to the sector's growth. So Bitcoin was the first cryptocurrency ever to be created and is seen as digital gold or gold 2.0, while Ethereum can be seen as a decentralized computer for the world. Welcome to the Financial Market Examiner YouTube channel, where you learn about forex, crypto, and the stocks market. So today on this channel, we'll see the differences between Bitcoin and Ethereum. What is Bitcoin? Bitcoin was the first cryptocurrency to be launched that functions independently on any central authority. The first block of data on this blockchain, known as the Genesis block, was mined in January 2009 by its pseudonymous creator Satoshi Nakamoto, and since then, Bitcoin's adoption has been steadily growing over time. Bitcoin was created as a peer-to-peer electronic cash system, which means that transactions can be conducted without any central authority. While Bitcoin uses blockchain technology for monetary transactions and allows notes and messages to be attached to each transaction, Ethereum takes it a step further by using the blockchain to create a decentralized computer. Ethereum is a decentralized open source and distributed blockchain network powered by its native cryptocurrency ADA, used to make transactions and interact with applications built on top of the Ethereum network. Ethereum's white paper was published in 2013 by its co-founder Vitalik Buterin, detailing the use of smart contracts, which are self-executing agreements written in code. Key difference between Bitcoin and Ethereum. While both the Bitcoin and Ethereum networks are based on the concept of distributed ledgers and encryption, they are vastly different in terms of technical specification. For instance, while Bitcoin serves as the digital equivalent of gold used to store value, Ether was used to power the Ethereum network and its applications. It's possible to issue new tokens on both the Bitcoin and Ethereum network. Bitcoin uses the Omni layer, a platform meant for creating and trading currencies on the Bitcoin blockchain. The Omni layer adoption is centered around stablecoins, Ethereum tokens, and on the other hand, they are issued following different standards, with the most popular one being ERC20. The ERC20 standard defines a list of rules for the token on the network. The ERC20 standard includes several functions developers have to implement before launching their tokens. This function includes providing information about the token's total supply, providing account balances on users' addresses, and allowing funds to be moved between addresses. Bitcoin transactions are monetary in nature, but transactions can have notes and messages affixed to them by encoding these notes or messages into data fields in the transactions. Ethereum transactions can contain executable code to create smart contracts or interact with self-executing contracts and applications built using them. Other differences between those networks include the time for new blocks of data to be added, which determine the time it takes to confirm transactions. Blocks on the Bitcoin network are added on average every 10 minutes, while on Ethereum they take about 15 seconds. Public wallet addresses are also different on both networks. These wallet addresses are unique identifiers that allow users to receive funds comparable to an international bank account number, which is a unique identifier financial institution used to identify which bank and country a client's account belongs to. And on Bitcoin, addresses can start with a 1, a 3, or a BC1, while on Ethereum they start with OX. While both Bitcoin and Ethereum have relied on proof-of-work consensus, Ethereum is moving away from it and into a proof-of-stake consensus algorithm. Proof-of-stake operate depending on the transaction validator stake in the network. To become validators on Ethereum, which are entities that verify transactions to ensure the network isn't being tampered with, users have to stake their ETH. Proof-of-stake consensus algorithm limit the energy necessary to reach consensus by attributing mining power to the proportion of validators' token instead of having miners with specialized computers. A proof-of-stake network is more energy efficient with lower entry barriers for validators and stronger immunity to decentralization because it's easier to become a validator. Bitcoin is also represented on the Ethereum blockchain in the form of ERC20 token to take advantage of that. A tokenized version of Bitcoin was created and launched on Ethereum. The numerous tokenized versions of Bitcoin on the Ethereum network, and these are backed by Bitcoin at a 1:1, meaning that for every ERC20 token representing Bitcoin in circulation, there is a 1 BTC in custody backing it. Tokenized versions of Bitcoin on Ethereum allow users to keep on holding BTC while using decentralized applications. For example, token holders can lend their BTC to earn interest. Bitcoin versus Ethereum scaling solutions. The base Bitcoin and Ethereum network both suffer from scalability issues. While Bitcoin handles on average 7 transactions per second, the Ethereum network is able to handle around 30 transactions per second. In comparison, Visa handles around 1,700 transactions per second, while claiming to be able to scale to 24,000. With the number of people using both blockchain grows over time, both Bitcoin and Ethereum have almost reached their capacity limitations and are in need of solutions that will help them accommodate more users. As it stands, both network transaction fees rise when demand for block space goes over what it can handle. With this, we've come to the end of the video today. Remember, this video is not for financial advice, but just for educational purposes only. Kindly share with us your feedback in the comment section and let's know how this has been impactful over time. Subscribe, share, and like after watching. Thank you.